Hello, it's Jeff McDermott from Create Wealth Financial Planning, and today I have a part one of a two-video series on inheriting an IRA. In this video, I want to cover a little bit about what the rules are as a beneficiary of an IRA, and then our next video is going to talk a little bit more about managing the tax implications of inheriting an IRA and planning well there. When we talk about inheriting an IRA and what the beneficiary options are, there's a line in the sand to be aware of. January 1st, 2020. So decedents who passed away before January 1st, 2020 and are leaving an IRA to somebody follow an old set of rules. Folks that passed away after 2020, which is going to be, most of anybody that's watching this video that's going through an inheritance process now, that follows the rules of the Secure Act, an act passed by Congress, which changed a lot of what options people had when they inherited an IRA. It speeds up a lot of the distribution of that money in many cases, and it can lead to more income taxation on that money if it's not managed well. All right, so first, just some quick basics around IRAs to level set. Pre-tax traditional IRAs, remember, they are taxed when the money comes out. So let's say, for example, we'll use the example of someone named Sally. If Sally were to inherit a traditional IRA from her mother worth $100,000, if she took the whole $100,000 out of that IRA and it all happens to be in the 24% federal tax bracket, Sally's going to pay $24,000 in federal income taxes plus any state taxes on that $100,000 of income that's taxed when it comes out of the traditional inherited IRA. Roth accounts are the opposite. Roth accounts are generally tax-free. There's a couple of rules that you do have to be aware of, but assuming the inherited account meets the two 5-year rules, then the full $100,000 can come out tax-free. Sally keeps the full $100,000 inheritance. And so when we talk about tax strategy, the kind of account it is and how to manage the income of those pre-tax IRAs is going to be super important. Okay, so if you are a beneficiary of an IRA, there's really three categories or three types of people that the IRS has defined that you could fall into. The first category is you are the sole surviving spouse, a 100% primary beneficiary. This surviving spouse beneficiary is the only type of beneficiary that can treat the IRA as their own. So the survivor can simply roll the decedent's IRA into their own personal IRA. All of the rules around IRAs with respect to early withdrawal penalties, required distributions, taxation, they all apply as if the account were the owners, the new owners, the surviving spouses all along. So for a lot of spouses, that is the best option, but not all cases. So for example, a spouse who inherits an IRA before age 59 and a half and is in need of cash might choose a different beneficiary option so that they could withdraw funds without a 10% penalty. We'll talk a little bit about that a little more in a minute. But going back to Sally, let's say she's a surviving spouse. She's age 70, so she's past that 59 and a half early withdrawal stage, and she inherits $100,000 from her spouse. She can roll that whole thing into her own IRA if she would like, do nothing, reinvest it as she sees fit, and she won't have any required distributions until she gets to her required minimum distribution age. So that's a special rule for surviving spouses who are the 100% beneficiary. Now, the second category is a category created by the Secure Act in 2020, and that is the category of an quote-unquote eligible designated beneficiary. So again, this is a person who has been named as a beneficiary to the IRA or retirement plan, and they are either a spouse, if the spouse chose not to take the IRA and treat it like their own. They are a minor child, okay? And once that minor child reaches the age of majority, they're going to move into the next category we talk about. But they could be a spouse, they could be a minor child, they could be disabled or a chronically ill individual. And that's typically meaning the IRS Social Security definitions of those terms. Or it could be an individual who is not more than 10 years younger than the decedent. So who could that be? That could be a sibling that's within 10 years of age or older. It could be an unmarried partner who's close in age or older, or other circumstances where the beneficiary is approximately the decedent's age or older by any amount. This eligible designated beneficiary typically gets to follow rules very similar to the pre-Secure Act, the pre-2020 rules, and they have to calculate an annual required distribution that they have to take over their life expectancy. They can always take more without penalty because this money is going to go on a special inherited account that avoids the early withdrawal penalty. And so this is a case where, again, that surviving spouse who is younger might want to take it and treat, instead of treating it as their own, move it into this kind of account so that they could use some of that money. They'll have to take minimums, but won't have any required distributions. How much do you have to take out? It's usually a small percentage of the account each year. It's based on your age. It goes up a little bit each year as you get older. And there's a lot of online calculators, companies like Schwab, Fidelity, Vanguard. They all have inherited IRA calculators where you put in the age of the decedent, your age, when they passed away, and it helps you calculate that required distribution number. So again, let's go back to Sally. Kind of talked a little bit about this. Let's say she inherited $100,000 from her spouse, but she's only 45 years old. They were a little short on life insurance. She could use some extra money to help pay for school for the kids. If she moves the money to an inherited IRA instead of her own IRA, she can take that money out penalty-free for childcare or whatever she needs it for, because that 10% penalty is waived on these inherited accounts. Okay, so that would be an eligible designated beneficiary. The last category, anybody else. Anybody who is named as a beneficiary on the account that is not a surviving spouse or an eligible designated beneficiary. These would be non-eligible designated beneficiaries, typically going to apply when the following generation inherits, like an adult child inheriting their parents' IRA or Roth IRA. The Secure Act in 2020 created a 10-year rule that specifies that the inherited account must be distributed in full by the end of the 10th year following the account owner's death. So that creates a lot of tax havoc. It requires those distributions to really be accelerated and happen in a much shorter window of time. And furthermore, something that the IRS came out and clarified last year in 2024, if the decedent, the person who owned the IRA and passed away, was taking required distributions while they were alive, the account owner also has to, the new account owner, the inheritor, the beneficiary, also has to keep taking required distributions in addition to distributing the whole account within that 10-year rule. So again, let's use Sally as an example. Sally's an adult. She inherits a $100,000 IRA from her mother, who was 75 and taking required distributions when her mother passed away. Since Sally's a beneficiary but not a, quote, eligible designated beneficiary, she needs to ensure, number one, that the entire account is distributed by the end of the 10th full year following her mother's death, and she'll need to take required distributions along the way since her mother had already started RMDs. Once an account or once a bucket of money had started required distributions, generally speaking, you can't stop those with rare exceptions. Now, that last option in particular, that non-eligible designated beneficiary who has that 10-year rule to deal with, like I said, that can create a lot of unique tax challenges. So the next video is going to outline some things to watch for as an IRA beneficiary, how to mitigate that 10-year rule with some smart tax planning. So make sure you watch that one as well if you're in that situation. And please reach out with any questions or anything at all that I can help you out with, especially if you're an IRA beneficiary and you need some help working through this. All right. Thank you very much.